friends, welcome to Nirmal Bang. I am Piyush Jain, and today we are going to take you to the world of debt. Now, as we know, bonds and equities they go hand in hand. Many times in the stock market, we actually take a look at the bond yields, and then we actually sort of start worrying like what's happening to the equities. There are many sort of instances of correlation. Even when you take a look at the banks, the yields become very important. If you take a look at corporate treasuries, they hold a lot of bonds and also again basically derive a good sort of treasury earnings. So whether you are into a stock market or you are directly into debt market, watching out debt market, watching out bonds, and also understanding from the industry participants about how the debt market is performing is equally important to really understand the health of the market. And for understanding the bond market, let me today now welcome an industry expert, Mr. Devang Shah, co-head fixed income of Axis Mutual Fund. Devang, welcome to the show.
Thank you for inviting us.
So Devang, you're an expert. Like you manage like thousands of crores in the bond market. Let me sort of ask you first question here about the markets. If I take a look at the markets, and I'll start from a perspective of for our viewers for the equity markets. Now I was taking a look at the equities here. Largely, U.S. markets are sort of good bounce back this year, like for the first five months. 5% to 14% between the S&P and the Nasdaq. European markets have done well. Asian markets, we have largely been flat as a Nifty or minus 1% down. Except again, if I just take out basically sort of Thailand or a bit of Korea, not Korea, in fact Indonesia, rest all markets have done well. In that context, Indian equities have not done well. And when you take a look at that, and then you actually then expect that the bond market should be really outperforming. So from that perspective, what is your assessment of the Indian bond market, long and short-term yields? How basically you would see that?
So I think good question from a perspective on currently in this context of macro, and you covered a lot of global markets, lot of global events. So how things should pan out for bond markets, and it is very crucial time at this point of time because last 2 years we've actually seen a lot of volatility across asset classes, specifically bond markets also. If you just to give you some bit of recap, I'm sure fixed income it doesn't entice too much of investors because it's an asset class where I think equity generally is an asset class which is loved by all the investors. But when it comes to fixed income, I think generally the thought process is the general expectation is fixed deposits. Fixed income, from a perspective of understanding and learning, if I look across at the levers of fixed income, which generates alpha and returns for investors, there are three levers. One is the interest rate cycle, which is the duration part of the portfolio. The second is taking up probably a play or having some allocation to largely accrual strategies, which are credit strategies. And third is the liquidity play, which I think also covered across about global liquidity, global market. So it's all also about banking liquidity in India. So these are the three levers which actually leads to alpha as well as generation of returns in fixed income products. If I look across at the last 12 months, I think just to again give a recap, we had seen a lot of volatility and increase in rates across global markets. And that has been some of the reasons also why you touch base upon equity as an asset class didn't perform well for certain markets. The thought process can be because squeeze of liquidity, interest rate hikes generally doesn't augur well for risk on assets. So the reason for the panic and the increase in rates by all central bankers across the world was the Ukraine-Russia crisis, which led to uncertainty about supply chain inflation, which led to uncertainty about oil, and we saw a panic reaction everywhere. Obviously, Fed moved from discount to 5 quarter. If you look across at RBI, also RBI has moved from 335 to 6.5. So there has been a significant change in operative rates across India as well as across other global economies. What we believe now is analyzing macro environment, analyzing macro points. I think when we look across an interest rate cycle or fixed income products, certain important points which we need to consider it while deciding our portfolio allocations has been growth and inflation. If I look across at the inflation parameters, like last year, there was a lot of uncertainty about inflation, where it will settle into, what will be the expectation on oil, can we see any kind of financial crisis? I think today we are quite much more certain about that inflation is heading lower. Even if OPEC is cutting output, we are actually seeing crude prices to fall, which itself shows that global demand has started to weaken. Secondly, the important aspect, which is growth. I think again, we have, because of liquidity tightness, interest rate hikes, I think we have started seeing some impact on growth. So combination of all macro indicators, be it growth as well as inflation, are all showing downward trend. And that leads to the thought process for us that yes, the peak of interest rates are probably, we are in the peak of the interest rate cycle, and from here interest rates are headed lower. And what do I mean by that? By, in simple terms, we'll start seeing, after, with a lag effect, obviously in the next 6 to 12 months, central bankers across global economies, and obviously India will also be a party to it, where we start seeing RBI also cutting rates. So today, from a macro point of view, I think these are very, very interesting times for fixed income investors. And from here on, where we are actually at the peak of the interest rate cycle, we have started advising clients. We are advising, in fact, since last 3 6 months, that we will probably see the peak of interest rates for India in this cycle at around close to 6.5. And structurally, investors should start increase duration of their portfolio, start allocating to fixed income products. A second corollary which I'll try to put across is that I'm sure traditional investors have always looked at investing in fixed deposits, and they have this thought process where in India, in fixed income, when fixed deposit rates are closer to 8%, generally it's a good time to invest. When I look at the curve today, I think you pick up 1 year to 15-year corporate bonds in India are all trading between 745 to 760. And hence, we are absolutely very close to the peak levels. And our thought process is structurally, as well as from a valuation perspective, fixed income markets are very attractive right now for a medium to long allocation, and with the thought process to play the interest rate cycle.
Right, and I picked the headline that you have a view that we have seen the peak of the interest rates, and I want to sort of reaffirm their view by asking you this question. I was seeing the Fed commentary where actually they increased the interest rates by another 25 basis points. ECB maintained the interest rate stance. We actually saw another Asian central bank increase the interest rates. From that perspective, and when I match this with RBI and the Indian events, edible oil prices are now down marginally a month on month, but still versus last year, almost 35 to 40% down. Crude oil prices have declined, two major sources of inflation. Monsoon related perhaps is an yearly event, but largely we have seen the decline in inflation as we're just highlighting. From that aspect, uh, how you are really comparing, one is global led rate hikes and second is domestic led comfort. uh, will RBI be now in a comfortable position to ignore the global sort of rate hike events and then just fully focus on data, domestic data?
So I think if you actually ask me, RBI has already done that. RBI has ignored the Fed hike, and everyone know Fed was going to hike in yesterday's policy, day before yesterday's policy. But the thought process for RBI was slightly different. RBI believes so that they've already hiked significantly from 335 to 6.5. Currently, India inflation, and you rightly pointed out, not only these factors, I think the base effect comes into play, and structurally we have started seeing a bit of high frequency indicators slowing down. All this augurs well for inflation. Our base case scenario for the next quarter inflation is 4.5. If you look across at the full year inflation numbers, also we are in the more in the with RBI, where the expectations are closely around 5.25 to 5.5% band on CPI. With 5.5% CPI numbers for the full year, and we don't see significant pressures on inflation due to global factors also, 100 basis real rate, I think RBI would be very, very comfortable at 6.5 on operative rate. So I think RBI has already shown that kind of disassociation with the global central banks, where they are still hiking or probably very close to their peak, and RBI chose to do a pause. My understanding is incrementally from here on also, macro data still would be surprising RBI on the downside. Inflation also will be on a downward trajectory. Growth will start showing some weakness. In fact, the only number in RBI's monetary policy, which we believe so RBI can see some bit of surprise, is the growth side. They are projecting growth at 6.5. Our belief is that yes, growth will be better than most rest of the world, or probably the larger economy, developed market economies. But I think RBI will see some bit of surprise there, and India growth trajectory will be close to 5.5 to 6% for this year. I'm talking about FY24, March 23 to March 24. So our perspective is, with that downward surprise on growth, macro indicators, specifically inflation showing a downward trend, the play on interest rate cycle continues. And yes, RBI will be on a pause. They will not be the first to cut rates also. So even if we see some accidents globally and Fed's pivots and Fed starts cutting rates, I think RBI will not join the party soon, and they will be very, very data dependent. If they see significant growth shocks, that is where probably they will start cutting rates. Or if inflation falls massively below a 5% and goes in the 4.5 to 5% camp rather than a 5 quarter, 5 half camp, I think RBI will cut rates.
Right, I think it's easier actually really for a fund manager like you to actually when the RBI focuses on data because it's more predictable. But keeping the focus on the data here, I was taking a look at the trend on the 10-year bonds, Indian bonds, and what was sort of really interesting was 7.3, 7.4% sometime back, started gliding down, eventually drifted below 7.1. Is this something which the market has already concluded? It's not surprised that market is pricing in earlier because we all know whether it's equity or debt, market always starts pricing in earlier. But is the market telling us that yes, the sort of bond rally is now starting and it's looking like a good year for the bonds?
So I probably agree with this because somewhere down the line, I think you rightly pointed out. So long bonds, as you rightly highlighted, I think long bonds take into expectations, future projections. Okay, they price in future projections on CPI, rate cuts. That is why, because the majority of the bond is 10 year. So you start pricing in what will be the average inflation, how interest rate cycle will move, and things like that. When it comes to the shorter end of the curve, the shorter end of the curve is very, very linked to the repo rate. Okay, they start behaving, or the yields for them start going lower as and when the rate cuts get delivered. So it's always been the case, when you start anticipating the rate cut cycle, you start seeing the curve to get flat, and probably you will start seeing the short end of the long bonds rally, and the short bonds start to rally once the rate cut cycle starts. We believe that the long bonds, there was a couple of surprises which also led to the fast rally in bond markets in the last 30-40 days. I think if you look at early March, first week or second week of March, we were at 745 on 10-year bond yield. And a couple of days back, we touched below 7. So there was a 40 odd basis of rally in 10-year G-second. It's good amount of a rally. The reason being, I think it's two, three factors. One, Powell, as compared to Powell's speech, the Fed governor's speech in March, the actual decision which came across in March end was slightly more dovish because of the global bank crisis, which we have seen SVB, Credit Suisse, a couple of banks collapsing. I think the guidance as well as the commentary from Fed governors were a bit dovish. So that surprised markets. The entire global financial contagion which happened on account of SVB, the liquidity, the the financial conditions getting tighter, I think all that led to the rally. The second thing is RBI paused, okay, on early in early April, and probably that was another reason, because a large part of the market participants were expecting RBI to hike. RBI did a surprise pause, and that led to the rally to continue. I think these are the couple of reasons why we had seen decent rally. But from an overall indication perspective, completely agree with you that debt markets are forward looking, long bonds specifically are forward looking, and they have started pricing in that the peak of the interest rate cycle is behind us. Incrementally from here on, in the next 6-12 months, we start seeing rate cuts, and hence the rally in long bonds.
Absolutely, as you were just saying. In fact, look at the irony here. Actually, the bonds have already delivered 4% returns this year. If you're just seeing the YTD, where it's the 30-year, 10-year bonds, 5-year bonds, almost 4% or plus minus 20, 30 basis point here and there, and they're outperforming the benchmark equities by a good margin here. So that's from the bonds. But Devang, I will be tempted to ask you. I want to ask you right now, basically, what's a good area for looking to really position the money here? Is the short tenor bonds or it's the long tenor 10-year bonds? Because as per your description, I was trying to understand that if 10-year moves first and then actually the short tenor moves later, then perhaps maybe 10-year has already moved. So I think the short tenor might be looking more attractive. What's your view?
Right. So, in fact, good question, because it is important. So, I always tell investors, and specifically for fixed income investors, that two important criteria which they should select for while advising funds as well as investing in fixed income funds. I think the first important aspect is the choice of the category, which is credit, duration, or the short end of the curve, which is more liquidity driven, which I told you also these are the three levers which generate returns for investors. And the second is matching your investment horizon. I think if your investment horizon is very short term in nature, I personally believe always the money market funds makes a lot of sense for these investors, because you do not want to ride the interest rate volatility on the wrong side and probably have a bad experience, investment experience. So the thought process for us is match the investment horizon and then probably find a suitable product for them. Currently, looking at the macro cycle, I still believe that today the funded curve is only pricing in, I would say, not more than 25 basis of cut also. Okay, or swap curves, which are indicators of where rates should go probably 1 year hence, is pricing in close to 50 to 75 basis of rate cuts. So as per me, I think there is more rally still to come in the long bonds. Obviously, there can be tactical pullback in yields. You can see yields probably from 7% first going to 7.15, 20, and then probably going down to 6.75. So there can be better entry levels. But from a structural 6 to 12 month perspective, I think first we might see the rally more in the long bonds and then probably start shifting to shorter bonds. If you ask me from a category perspective, what we're advising is all seasons funds, dynamic bond fund categories are the best category at this point of time for investors, where the fund manager would elongate the duration at this point of time. And once the rally is broadly done, they would switch to shorter end of the curve and try to benefit out of the curve steepness. So once the rate cuts start coming in, the short end of the curve will start behaving better and outperform the longer bonds. And fund managers will also shift there. The second category, which we probably like, which is a mix of credit, accrual, and duration, is the medium term category. So these are the two categories which we are actually advising. A medium term also captures duration, but not with the same rate, because I always see investors in broadly two sets. One is a slightly conservative investor who wants a risk-adjusted return, and a second category investor who actually believes in the fund manager in the fund house and want to probably ride the interest rate cycle and is okay with volatility. For the first category, which is a more conservative investor, I think medium-term duration category makes the most sense. And for the second category investors, I think dynamic stroke all seasons bond fund makes a lot of sense.
Right. So second category where actually they are taking a bet to the fund managers, dynamic funds. The first category, but please repeat what you just took the name.
Medium term category.
Okay, fine.
Is
So
3 to 4 year duration.
okay, fine. So those actually are the two sort of views for our viewers. I think our viewers largely will actually sort of see that it's easier to sort of go with the dynamic funds, because then you don't have to really sort of think around anything. But yeah, as you just explained, perhaps both the categories. But looking at that, is there any also sort of preference in the corporate bonds when you pick any sector particular which you're liking right now? Like you might be looking at how the corporates are performing, how the earnings season is going, what's the overall flavor of the sort of earnings quality. Is there any sort of particular sector preference, or is it largely only data driven?
So, see, for some reasons in debt market, I would say 70-80% of the issuances come in the finance sector only. Okay, so we are and financial sector, and again, if you look at the portfolio, underlying instruments, securities, a large part of it, around 50 to 25% will be government bonds. 30 to 40% will be public sector undertakings and public financial institutions, which will all be AAA rated. And the balance 30 to 40 odd percent is a mix of sectors and corporates. That's how the investment happens in fixed income products. If I look across it, you asked about how the earnings have been and how the growth indicators have been. I think currently there are no early signs of any kind of massive slowdown. So we are just seeing some bit of turning points, I think, but too early to jump the conclusion that we have actually started seeing slowdown. If I look across at a corporate guidance, if I look across at the sector-wide overall earnings, I think they have been reasonably okay. The corporate guidance continues to remain strong. We are seeing data, we have seen some bit of data where high frequency indicators have started showing a bit of slowdown, but I would say it is not immediately any kind of money. From a sector or a corporate bond spread perspective, I think the typical question which investors have, specifically for fixed income, is like, are the spreads from corporate bond issuances attractive enough for investors to invest? Our belief is today, if I look at the short end of the curve, which is up to 5 years, the corporate bond spreads are neutral and reasonably okay. They are at 50 basis spread over GSEC. Just to explain your investors once again, I think GSEC is where the base curve is, like 1 to 10 year GSEC currently is trading at close to 7 to 710. The entire corporate bond curve, which is 1 to 15 years, is trading at around close to 740, 750 levels. What we believe so is that up to 5 year segment, the corporate bond spreads at a 30 to 50 basis spread are okay and neutral to hold. Anything beyond 5 years, where a corporate bond spreads like in 10-year GSEC is close to 7705, 10-year corporate bonds are close to 735, 30 basis spread, I think the spreads are too compressed. We can see some bit of spread widening there. Overall, not to get worried about credit or significant corporate spreads widening or a bad season's earning at this point of time. But for the longer tenor bonds, we can see some bit of spread widening.
Okay, so that's a sort of good benchmark here. If you basically want to sort of round off our entire conversation, on a 10-year, 6.5%, is that something which you're expecting in the year? Somewhere down the year?
I would say 6.5 to 675 is what we expect. So, by obviously, because I think the rally might be all front-ended, and then probably you start seeing. It depends on how the overall budget gets designed next year. So, if you ask me a March 24 level, I'll be more in the. I will be watchful because the last budget, it will be a vote of account budget before elections. And I believe so. Currently, from here till March, our understanding is 6.5 to 675 is the band where we see long bonds.
Right, and on the short bonds?
So short bonds, as I told you, I think the thought process is how we have generally seen the short bonds start rallying once the rate cut get delivered. There are many theories, and I believe so that it will be difficult for RBI to cut rates before Fed. Okay, and unless and until we see huge accidents, we are not in a camp where we believe that the financial contagion will be huge and we will start seeing too many rate cuts. Okay, we believe that even Fed will start cutting, Fed will pivot, but probably it is in the September quarter, and that is where probably we start seeing markets start pricing in rate cuts. Probably RBI will deliver not before Jan to March the rate cuts, and unless until we see a massive growth slowdown. So for me, I think the short end of the curve will start rallying in the last quarter. Currently, 3-year, 4-year corporate bonds are at 7.5. We believe with a pricing in of 6% operate repo rate, and that is what is our expectation by June 2024, that we will see repo rate closer to 6%. We believe that 3-year corporate bonds will move from current 7.5 levels to closer to 6.87% band.
Okay. Okay, so I think those I think are good guiding factors for our viewers, and also very nicely and aptly explained by you that if they actually are looking at the funds, investing into the debt funds, then the sort of longer tenor funds actually right now are looking good. Dynamic funds or medium duration funds, those perhaps are the two sort of options or two paths again basically which is being laid out by Devang, our fund manager on the show. Devang, it was a pleasure talking to you. Always we actually get a lot of intelligence from the debt market for our viewers, and we look forward to having you again on the show.
Thank you for having me.
And dear viewers, I hope you enjoyed it and hope you gain insights on the debt market. With that, it's a wrap on the show.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.